Welcome to the deep dive. Today, we're taking a really close look at Computer Age Management Services Limited, CAMS. We're digging into their Q1 results for the fiscal year 26, so the quarter ending June 30, 2025. And our mission, really, is to understand the shift. CAMS has always been this super stable, almost utility-like player in financial infrastructure.
The backbone of the mutual fund industry, essentially.
Exactly. But now they're pushing hard into diversification, lots of high-tech stuff. So are they actually managing to evolve from that stable utility into maybe more of a growth-focused fintech? That's the question.
And that's precisely the tension we need to explore. I mean, just for context, CAMS is the biggest registrar and transfer agent RTA for mutual funds in India, period.
Yeah.
They handle something like, 68% of the market share? It's
Okay.
huge. That's a massive moat, a ton of data.
Right.
So when we look at their future, we have to see how they're doing both things, protecting that core dominant business and, maybe more importantly, how they're speeding up growth in that other slice, the 13% of revenue that comes from outside mutual funds.
Okay, let's start with that core engine then, because honestly, these numbers show incredible scale, operational muscle. The big headline this quarter, assets under management AUM. It crossed a major, major milestone, over 50 trillion rupees in June 2025. And they held on to that roughly 68% market share.
Yeah, and what's really interesting isn't just the sheer size, but like the type of growth. Overall AUM, solid, up 22% year on year.
Yeah.
But drill down into the higher margin stuff, the equity assets, that performance was, well, frankly stellar.
Okay.
Equity AUM went past 25 trillion, hit ours 26.7 trillion. That's up 24% year on year.
Right. And that 24%, that's actually faster than the industry's overall equity growth is.
Exactly. Which means CAMS is capturing more than its fair share of that profitable shift towards equity. They're winning where it counts.
And if you want proof of just how big retail investing is in India now, you just need to look at the SIP numbers. Systematic investment plans. That's the pulse of committed retail money.
Oh, absolutely. And CAMS is just crushing it here. New SIP registrations up 19% year on year. That's 11.2 million new plans started in one quarter.
11.2 million. Wow.
And it's not just volume. Their market share grab for new SIPs jumped 6 percentage points.
Yeah.
That's huge. Brings them up to 67% share of new registrations.
Okay, so they're grabbing the new flow. What about existing ones?
That's strong too. The number of live SIPs, ongoing ones, grew 15% year on year, and their market share there improved too, up to about 62%. This isn't just fleeting interest, it's locking in recurring revenue streams.
For me, maybe the best long-term signal is how fast they're bringing totally new people into the market. Their unique investor count crossed 41 million. It's at 41.5 million now. That grew 27% year on year.
Which is faster than the industry's 22% growth.
Right. 5 points faster. So they're not just shuffling existing investors around. They're actually bringing more new blood into the system than competitors.
And that dominance naturally pulls in big clients. They mentioned, I think, 3 of the 7 new AMCs they signed recently went live this quarter, including the big one, Geo BlackRock MF. MMS got the servicing mandate for them.
Yeah, that Geo BlackRock launch was a pretty big deal. Their first fund offer, an NFO.
Like an IPO for a mutual fund, yeah.
Right. And it pulled in, 17.8 billion rupees? CAMS said it was the largest NFO ever on their platform.
This is significant. And they're looking outwards, too. They launched their first international AMC client, SoBank AMC, from Sri Lanka.
Okay, so they're definitely trying to package that core tech expertise for markets beyond India. All right, so the core mutual fund engine is clearly firing on all cylinders. But are they using that power effectively? Which brings us to the big bet, the diversification, the beyond mutual funds strategy. Now, this part brings in 13% of the total revenue. But, and this is the interesting bit, despite all the activity we're about to discuss, it only grew 4.4% year on year, which feels a bit slow.
That 4.4% figure, yeah, that's where the strategy gets really interesting and maybe challenging in the short term. We need to unpack why it might look slow, especially with all the operational moves they're making.
Okay, so let's break down these diversification efforts. Maybe start with the areas playing to their strengths in, like high-value services and regulatory infrastructure.
Good idea. Let's start with CAMS alternatives. This covers things like alternative investment funds, AIFs, and their WealthServe platform. This is typically high net worth complex stuff. They signed up 50 mandates in Q1 alone. That includes 24 totally new clients. And significantly, 3 clients based in Gift City.
India's international finance hub. Getting clients there is a good sign.
Definitely signals traction in that high-value, potentially international space. Their assets under service, AUS, in this alternatives area is now over ours, 2.7 trillion. So there's real scale building there.
And sticking with that regulatory theme, CAMS, the KYC registration agency, they made a big move here, right? Acquiring the KRA business from NSE Data Analytics.
Huge move. Strategically very smart. Buying 1.3 million existing KYC records basically gives them an instant boost in validated client identities. It deepens that regulatory moat, makes it harder for anyone else to compete.
Makes sense.
Plus, they added another top 5 brokerage house as a client. And they're pushing speed too, talking up their 10-minute KYC process. That's a big convenience factor in a market bogged down by paperwork.
Okay, what about insurance, CAMS rep?
Insurance repository.
Yeah.
It's more about volume, I think. Their policy base grew 41% over the past year. That's up to 12 million policies now.
Wow, 41% growth.
Yeah, and they're holding on to a market share over 40%. The big catalyst everyone's watching for is LIC, Life Insurance Corporation of India. They're expected to come on board for insurance accounts in Q2, so the current quarter. That could be massive.
And they launched something called Bima SBA.
Right, for premium payments. It's
Yeah.
like the ASBA process for IPOs, where funds get blocked in your account, makes payments smoother. They've got 3 major insurers using it already.
Okay, now let's shift to the really tech-heavy stuff. The platforms that signal that fintech transformation ambition, CAMS pay the payments arm.
Yeah, they're building out serious infrastructure here. Their own payment gateway for cards is now LiveWorks with MasterCard, RuPay, Visa.
So they're moving beyond just collecting mutual fund payments.
Exactly. And it seems to be paying off somewhat. Their assisted revenue from payments grew 26% year on year. They're still the leader in MF payments, obviously, with over 4 million UPI autopay mandates registered.
And the really future-forward bets. Think 360 AI and data analytics and CAMS FinServe.
Okay, Think 360, this shows their capability, I think. They highlighted building an AI-powered data platform described as an industry first for a U.S. health tech company.
A U.S. client for AI services.
Yeah, proves they can export complex tech services, not just process Indian transactions. Plus, their video KYC product, KWIC.ID, went live with a major credit card issuer, so embedding tech directly into financial workflows.
And lastly, CAMS FinServe in the account aggregator space. AA is potentially transformative, letting people share financial data securely.
Right. And CAMS is leveraging its deep industry ties here. They've got 94 FIPS financial information providers, like banks, live on their platform, and 176 FIUs financial information users, like lenders, live.
So lots of connections being made.
Yeah, and they're focusing on practical uses like speeding up digital loans or opening trading accounts. It's about making data flow work.
Okay, but hang on. Let's go back. They signed 50 alternative mandates, buy a KRA business, launch their own card gateway, build AI for U.S. clients. If all that's happening, why did that whole non-MF revenue segment only grow 4.4% year on year? It feels like a mismatch.
That is the critical question. You're right. That slower growth rate suggests, well, probably a couple things happening at once. Either these new businesses just haven't hit their stride yet in terms of transaction volume.
Right, still early days.
Or, more likely, the upfront costs of building all this, the tech, the acquisitions, the infrastructure, are still weighing down the reported revenue growth. They're spending heavily now to build those platforms, like the payment gateway or the AI team.
So investment phase.
Exactly.
Yeah.
The revenue from those efforts will likely ramp up, but it takes time for the scale of these acquisitions and new platforms to translate into big top-line growth numbers. That 4.4% probably reflects that initial, maybe lumpy phase of getting these new regulated services off the ground. We should expect, or at least hope, to see that accelerate.
Okay, that makes sense. Spending money to hopefully make more money later. Let's look at the actual consolidated financials for Q1 then, see how this plays out on the bottom line.
Right. The overall picture shows steady top-line growth, but yeah, confirms that significant investment cost. Total revenue from operations came in at about 354 crore. That's up a respectable 6.9% year on year.
And we already established the powerhouse is the core asset-based revenue, the mutual fund stuff. That grew 8.8% year on year, right?
Correct. That reflects the strong AUM growth we talked about. Now, the non-asset-based revenue, which includes a lot of these newer tech things that actually dip slightly, down 1.1% year on year.
Interesting.
which kind of reinforces that idea. Implementation costs, maybe some initial integration drag, hitting the immediate visibility of revenue from those new services. But remember, the overall non-MF segment, as a reported category, grew 4.4% year-why. So the underlying businesses are growing modestly, even if specific line items fluctuate.
Okay, so revenue's growing okay overall. How did all this investment hit the profit numbers?
Yeah, profitability is where you really see the cost of building that future. EBITDA grew, but only by 2.8% year-on-year. That brought the EBITDA margin down slightly to 43.7%. Still very healthy, but growth is slower.
And profit after tax? Pat.
Even slower growth there. PAT was up just 0.8% year-on-year. The PAT margin landed at 29.7%. So again, healthy margin. But the flat growth tells you that expenses grew faster than revenue year-on-year. They're funding that diversification.
What in the profit and loss statement specifically points to that spending?
Well, you see, employee benefits expense up year-on-year. That likely reflects hiring for tech, AI, those specialized roles needed for the new ventures.
Makes sense.
And other expenses, which covers a lot of ground, including operating costs for new infrastructure and maybe non-operating costs linked to setting up subsidiaries or acquisitions. That line item saw a significant jump year-on-year too. They're absorbing the cost of things like launching that card payment gateway, integrating the KRA business they bought. That hits near-term PAT growth, but the bet is it buys them long-term market leadership.
And despite that pressure, they still paid a dividend.
They did, an interim dividend of Rs. 11 per share. So, still returning cash to shareholders even while investing heavily.
Okay, beyond the financials, CAMS is also making sure to tick the boxes on corporate stability and ESG commitments.
That's right, and it's relevant. When a company is undergoing this kind of strategic shift, having a stable foundation matters. They highlighted the management team's experience average tenure over 27 years in financial services. That kind of stability helps navigate big changes.
And on the ESG front, environmental, social governance.
These seem to be taking it seriously. They mentioned they completed their greenhouse gas inventory scope 1, 2, and 3 emissions for the last fiscal year. That's quite detailed.
So measuring their footprint.
Exactly. And they're apparently working towards setting an actual net zero target within this fiscal year. Their CSR work also seems concrete. They mentioned specific projects like restoring a lake and planting trees, tangible stuff.
And just to quickly recap those big strategic moves we mentioned earlier, buying the NSE KRA business in 2024, getting the final RBI nod for CAMS Pay as a payment aggregator also in 2024.
Foundational approvals.
These aren't just ideas anymore. These are regulator-approved, implemented building blocks for that diversification strategy. It shows real commitment from the top. #tag outro.
So wrapping this up, what's the main takeaway for you, the listener? It seems pretty clear. CAMS is using its incredibly dominant cash cow core business, the MFRTA segment.
Which is still growing nicely, especially the high-margin equity side, thanks to SIPs. Right. They're using the fuel from that engine to fund a really ambitious and probably necessary push into these related tech-driven areas: AI, account aggregation, payments, alternatives.
Absolutely. And that tension we started with, it's still the heart of the story. You have this incredibly strong core business, that 68% market share, growing well in the profitable segments. That's the defense. Then you have the offense, these rapidly expanding but currently small revenue, only 13.0% total, non-MF businesses where they're investing heavily. So the big question becomes, which part defines their next chapter?
Right.
Is it about maximizing the value of that near monopoly in the core business? Or is it about successfully executing this pivot towards being a broader, tech-enabled financial ecosystem? It raises that fundamental question for anyone watching CAMS. Do you view them primarily as a stable financial utility, or are they morphing into a growth-focused tech aggregator, potentially sacrificing some short-term profit for much bigger, long-term platform dominance? That balance, defense versus offense, stability versus growth, that's really the key thing to track in the coming quarters.
A really interesting balancing act to watch. Thanks for joining us for the deep dive.